Alright, I'm done with these banks and their pathetic interest rates. Have you been holding some cash and thinking recently, damn, I wish I could get some interest on it? Inflation is up and is eating it away, the central banks are raising rates, and here I am with my 0.01% yielding savings account. Well, if that sounds like you, then this video will solve your problem. I will explain to you why your bank is lying to you by giving you such a pathetic interest on your money while they take higher risks with it. Then we will go over what the solutions are for your cash. We will talk about normal bonds, inflation-linked bonds, and money market funds, and I will explain all of these in simple terms anyone can understand, giving you the solution for getting more out of your cash. So the reason I got interested in the topic is that after the spike of inflation in 2022, which went up by nearly double-digit percentages in almost all countries, the central banks raised their interest rates at the fastest pace in history to cool down the economy. When they did that, for the first time in around 15 years, my cash, which was sitting in my bank for different purposes like paying taxes, emergency business expenses, etc., should have started giving me some interest. Only it didn't. Now, as a person who has the vast majority of his net worth invested in real assets like stocks and real estate, I have never been a fan of keeping a lot of cash. Also, as I said, ever since the financial crisis in 2008, you could barely get anything on your cash regardless of what you did with it. So I never invested the time to learn more about the instruments we'll discuss today. But it is a basic principle both in personal finance and business that you have to have some cash for emergencies or for planned expenses in the future. Even the greatest company or fund fluctuates in value, and it would be really nasty if exactly when you need to fund your business or pay your taxes, it is down 20% and you can't do it. But in recent years, things have changed. Now, both inflation was way higher, so any cash just sitting around lost purchasing power much faster, and at the same time, the rise of the interest rates meant I should be getting something more for it. As a result, I embarked on a journey to find out what's going on and what the solutions are, and I will share it with you now. Hi, my name is Ognan and welcome to the channel where I talk about investing, personal finance, and how to achieve freedom and independence. So let's understand first what most people, including me a couple of years ago and probably you now, do with their cash. What we do is put it in a bank account so that the bank can keep it safe for us, and when we need it, we go and get it. Easy and simple, right? Well, that's not actually what happens. You see, the modern day banks are not vaults. They used to be, but this changed in the previous centuries, and you can check my video on precious metals I did on the channel to understand it better. In short, nowadays, when you give money to a bank, you become its creditor. You basically make a loan to it. This is something that blows people's minds, but it's vital for you to understand in order to take advantage of the rest of the information I will give you in this video. When banks get your money, they use it to finance their operations, which is lending. They lend money to governments, they lend money to businesses, they give credit cards, mortgages, all sorts of stuff. That means that when you put $10,000 in your bank, probably more than 90% of it isn't where you think it is. Yes, in order to prevent panic and to keep the illusion going, banks show you the number 10,000 in your mobile app. But 1,000 of it is in some government on the other side of the planet already. 2,000 went to finance the mortgage purchase of your neighbor Joe. 500 went for the business activity of the shoe manufacturer in the town next to yours. You get the point. So probably roughly 1,000 of the original $10,000 are still there. This is called fractional reserve banking. Now, the goal of this video is not to discuss whether that's good or bad or to make you panic. The reason I'm telling you this is to understand that all of you who think you are savers are actually lenders. We are all creditors to the bank's business activities. The only time you save is if you keep the cash physically. So you are taking the risk with your cash by lending it to a company that then goes out and lends it to businesses, governments, and households. If they pay you 1% yield but lend it out for 4% yield, they make 3% spread as their profit. That's the whole business model. Now, armed with that knowledge, you already know that you're risking your money by lending it. You are just doing it through an intermediary. Now, when rates are raised by the central banks, that means that all loans are made with higher interest rate. So the 4% average the banks lend your money for go up to, let's say, 6%. So you would expect your interest on your cash would go up from 1 to 3%, right? Only it hasn't. So what do you think happens with the difference? It goes straight to the bank's profit. Why aren't they passing that profit to you? Well, because why would they? People keep putting their cash in the bank. the bank keeps lending it out and the train keeps going. It's a pretty lucrative business model, and if you were in their shoes, you probably wouldn't be shouting from the rooftops that you could give people higher interest on their cash, but aren't. But hey, this is why I'm making videos on the channel. So now that you know this, the question you should be asking yourself is, why don't you start being the lender of these entities and pocket the difference, instead of making a bunch of bank executives richer than they already are? Let's find out how to do that. Now, the first thing banks do is lend to governments and corporations by buying bonds. I have a video on my channel explaining them, which is part of my Investing for Beginners guide, but really quick. Bonds are basically loans that can be traded on the market just like stocks can. They are a way for governments and corporations to get money for their needs. So when the banks get your money, one of the safest assets they put it in are bonds. So what you need to do is buy bonds and problem is solved, right? Well, not so fast. The key feature of bonds is that they are issued for a certain time period. During that time, you get paid interest, or what is known as coupon. After that time is over, the bond matures and you are returned your original money, called principal. Think about it as the bond having a birth date and a death date. Let's say the German government issues a 5-year 10,000 euro bond. The 10,000 euros are what's known as face value or par value. It doesn't change. The interest rate is 2% per year, and that is fixed as a number for the whole time. This is important for you to understand for what comes in a bit in the video. The 200 euros are fixed, not the 2%. So you buy the bond for 10,000 euros. In each of these 5 years, you get 200 euros per year. On the 5th year, the bond, quote unquote, dies or matures, and you get your principal of 10,000 euros back. So as you can see, the first issue here is that you need to wait for 5 years to get your original cash back. At this point, this turns into an investment, not a cash substitute, because you don't have access to it, which defeats the purpose of you holding the cash in the first place. So it's not cash, it's an investment, and it's a lousy investment, but more on that later. Now you might be thinking, well, if it is traded like stocks, then I can sell part or all of it when I need, right? Well, not exactly. Technically, you can, but as I said, since the bonds are traded on the open market, their prices fluctuate all of the time. The only way you are guaranteed to get all of your original money back is if you hold to maturity, or in the previous example, up to the 5th year when the bond expires. If you sell it on the 3rd year, it is entirely possible you will get 8,000 euros instead of 10. Or maybe you can get 12,000. No one knows. The price of the bond is inversely correlated with yields, which means that when yields go up, prices go down, and the reverse. So when central banks raise rates for a whole variety of reasons, the price of the bonds that were already issued drops. This happens because if our 5-year bond that we got from the German government a year ago gives us 2%, but the one they're issuing now gives new investors 3%, then obviously investors have to be fools to purchase our 2% yielding bond for 10,000 euros and get 200 euros per year, when they can get for the same 10,000 euros a 3% yielding, newly issued 5-year bond and make 300 euros per year. Remember, I said a bit earlier that the 200 euros are fixed. In that case, they will demand us to sell it for a lower price than the original, or what's known below par or below face value, so that the fixed 200 euros payment becomes 3% of the price they buy it for. Because why otherwise would they purchase it from us? So now if we want our money before the maturity date, we have to sell it for less than we bought it for. Obviously not a good deal if what you're aiming for is to store your cash for when you need it. There are bond funds which are just like stock ETFs, basically a basket of bonds. These ETFs you can sell or buy whenever you want from your brokerage, just like you can with stocks. However, they don't solve the problem at all. They even make it worse. You see, bond ETFs, unlike individual bonds, never expire. If Vanguard has an ETF with 5-year bonds, they can't just let all of them mature, close the fund, and be like, sorry guys, that's it. No investor wants that. So obviously, the managers of the ETFs have to constantly buy new bonds and let the old ones mature. It becomes a constant treadmill of bonds entering the fund and expiring and entering and expiring. So in that situation, as you remember, it is hard enough to know what the price of a single bond would be in 3 years. Add to that 97 bonds, each purchased at a different date and maturing in a different year, and it becomes totally unpredictable, just like with stocks. So not only do bonds ETF not work as a cash substitute, but they can't even work for you if you want to get the same amount of money back. Here is what TOT, the BlackRock's ETF following the 20+ year USA government bonds, has done. It's down 25% for the past 5 years. Not a good place for your cash. The only reason I would think of to hold long-term bonds is if you have a fixed expense at a fixed date and you want to make some interest on the cash. Let's say you know in 4 years your kid is going to university and it costs X amount. Instead of letting that cash rot away in your bank account at 0%, you can get a government bond at 3%, get 12% on your cash for 4 years, and then get the principal you invested and pay for a university. In that regard, bonds are very good for long-term planning of known and fixed expenses in the future. Other than that, well, it's not the time and place for me to go into that rabbit hole, but I'll just play you a clip.
Simply flooded the system with money.
Yes, we did. That's another way to think about it. We did.
Where does it come from? Do you just print it?
We print it digitally. So we as a central bank, we have the ability to create money digitally, and we do that by buying treasury bills or bonds or other government guaranteed securities, and that actually increases the money supply. We also print actual currency.
See, they print it digitally. While you're getting your fixed 3% for 20 years and waiting for the 21st to get your original money back in the same amount, they have already devalued your currency by 300%. Anyways, the video isn't about that, so don't get me started. I just think that if you're planning to hold a bond for years and years ahead as an investment, you might as well buy quality stocks and ETFs that produce stuff, grow their profits, and protect you from inflation. By the way, if you want to find out my top 4 stocks and ETFs for the current economic and geopolitical environment we are in, go to the description, click on the link, and I'll send you my report for free. It will always be up to date regardless of when you're watching this. So, talking about inflation, some people think that putting their cash in an inflation-linked bond will do the trick. Unfortunately, that isn't an option either. Inflation-linked bonds are bonds which have their principal tied to inflation, so when it rises, it goes up. They are often tied to a popular inflation index like the Consumer Price Index in the USA, the Retail Price Index in the UK, and others. So if the inflation for 1 year is 4% and you bought a $1,000 bond with a 2% yield or $20 coupon, the principal $1,000 will be adjusted to go up to $1,040, and now the 2% will be $20.8. Inflation-linked bonds are an interesting instrument, but are not as great as they sound. You need to do a lot of research and have an outlook on inflation and interest rates in order to successfully buy these. If you expect there will be deflation or prices in the economy going down, it's not a good idea to own them because your gains can be wiped out. In our previous example, the $1,040 can go back to $1,000 if there is a 4% deflation. Most inflation-linked bonds offer a floor, so it won't go below the par value of 1,000, but despite that, all of your gains will be destroyed. Also, they play by the same rules the normal bonds do. When rates go up and down, these bonds go up and down too. If you have a situation where a central bank raises rates to be above inflation, which is the case now in a lot of places, then it will be more profitable to own normal bonds and the inflation-linked bonds will crash. This is because the newly issued bonds will have higher rates and will be more attractive to investors. So you basically have to get into the central bank decision and inflation expectations guessing game. Not a fun place to be if you ask me. This is the 3-year chart of a fund containing USA TIPS or Treasury Inflation Protected Securities. It's the iShares USD TIPS ETF. That's just a fancy name for bonds linked to inflation. As you can see, it has lost almost 3% in the past 3 years, exactly when it was supposed to protect you against inflation. And the downfall started exactly in the first months of 2022 when the inflation started getting high. Why is that? Well, because central banks started raising their rates at the same time to combat inflation, and as with normal bonds, when the yields rise, the value falls. So many people who invested in these types of bonds without doing their homework were shocked to see their inflation-linked bonds going down exactly at the time when they were supposed to protect them from inflation. With all that said, our second candidate to hold cash in, inflation-linked bonds, also won't make it. It's as volatile and unreliable as the standard bond. So what are we to do? Enter money market funds. Before I explain what they are and how to use them, if you're getting value from this video, please press the like button and subscribe to the channel so you don't miss more videos like that in the future. So money market funds, what are these? Sounds like a market for funds full of money. Sign me up. Well, a money market fund is a fund that invests in highly liquid, short-term debt instruments. These could be short-term government and corporate bonds, certificates of deposit, repurchase agreements, and all sorts of other fancy-sounding stuff. While these sound complicated, what you need to understand is that it's basically all debt which expires in a couple of days, weeks, or months. This is the crucial thing to understand and what sets them apart from normal bonds. If you remember, the long-term bonds move up and down in price unless you wait for them to mature. Well, here these instruments mature constantly and then the fund manager replaces them with new ones. So basically, the price of the fund is pretty insensitive to rates because the new debt instruments pick the new rates very fast and it's constantly recycled. Remember how wild the charts of the long-term bond fund look like? Well, here is how the chart of a money market fund with USA government bonds maturing in less than a year looks like. Flat, 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 and then the Federal Reserve starts raising interest rates and the returns start increasing. This chart is a chart of a money market fund that reinvests all the income from the debt instruments, and so the price simply steadily keeps going up. And this is a chart of the same one, but a version which distributes the income to the owners, and so you can see how the price goes up, 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 and then dividend is paid and it drops, and then again up, up, and then it drops. And because the income is distributed, as you can see, the fund's price has barely moved with only 0.6% change in years. So if you had put your money there a couple of years ago, you would have been receiving some income, and at any moment you could sell the fund and get your original money back. This is what you need if you're looking for a cash investment. Before I go into what types of money market funds there are, I want to quickly make a distinction between a money market fund and a money market account. While they might invest in the same thing, a money market account is offered by a bank or a credit union, not a brokerage, and is insured by the Bank Deposit Insurance System, the FDIC in the USA, and other insurance funds in other countries. They also typically have lower rates. Here is a good graph from Investopedia site I found where you can see the main differences if you want. Now, let's get to the types of money market funds. There are three main categories. The first one are those which invest in government debt. So this would be government bonds or debt of various agencies backed by the government. These are the safest ones for obvious reasons, because as long as the government can print money, they cannot go bankrupt. Then you have what is known as prime money market funds, which own short-term corporate debt. Usually they invest only in investment-grade debt, so basically high-quality companies. But still, the debt of companies is riskier than the one of the governments, and so the risk is higher and often so are the returns. Or they should be. One advice from me and my own research. If you see two funds, one investing in government debt and the other in corporate debt, and the second isn't giving you higher return, then that isn't worth it. Remember, you should always be compensated for the risk you take. And the third type is money market fund investing in municipal bonds. Now that you know what money market funds are and the main types, let's see what they are useful for. So, in my opinion, a money market fund is best used as a second step after your emergency fund. The emergency fund is cash that you keep either in a safe place physically or in the bank and is supposed to cover 3, 6 or maybe 12 months of your expenses depending on your life situation. If you have a more uncertain profession or children that depend on you, perhaps you have a mortgage, etc., I would recommend it to be bigger, possibly between 6 and 12 months. I personally go with 12. If you're not worried about any of the previous stuff, then something between 3 to 6 months would probably be okay in my opinion. Then once you have that, you can start thinking about investing and money market funds. To me, the money market funds are a place to temporarily store cash for some future needs. Perhaps you want to invest when a particular company gets undervalued and are waiting for an opportunity. Or maybe you have a business that you want to reserve some cash for in case it goes unprofitable for a few months. Or perhaps you are saving money for your taxes, but you have many months before you have to pay them and want to get some yield. For all of these choices, a money market fund is a great option. Now, here is what money market funds are not good for. First, they aren't good for long-term investments. Yes, the rates might be high now, but first, they won't stay like that forever. And second, even if they will, you will still underperform the market, which delivers, depending on which index you are looking at, roughly 7 to 10% annual returns. Another thing you shouldn't try to do with them is keeping cash in order to time the market. It has been proven time and time again that for the average person, this just doesn't work. We have a very clear recent example of that. By the fall of 2022, almost everyone was feeling pessimistic about the economy. They thought recession is coming, the stock market was at its low and was supposed to go even lower, etc., etc. Everyone was hiding in their money market funds, feeling good about getting their 5% yield, advising other people to wait until the worst passes. And what happened in the following year and half since then? Well, while all these people were hiding and waiting and getting their 5%, the S&P 500 index, surprising everyone, made 44%, while the Nasdaq 100 made 70%. I don't need to do the math for you to understand why hiding in a 5% yielding money market fund with cash you didn't need but wanted to invest at some point was not a good idea. It's been proven time and time again that it's almost impossible to time the market, and yet people still attempt to do it. With all that said, once you know how to use them and understand they are not a substitute for long-term investment, let's see why now is a very unique time for money market funds. I don't want to get very technical here, so I will try to explain it briefly and simply. The reason is something known as the inverted yield curve. I told you it would be simple. No, seriously, just like with most things in finance and investing, it isn't as complicated as it sounds. Remember how I told you that governments can issue bonds for 10, 20, even 30 years? Well, if you're going to lock your money with someone for 30 years and get fixed payment in the form of a coupon that doesn't change, a lot of things can happen in that time, right? Inflation could erode your savings. The government can go bankrupt and default on its debt. There could be a war or a pandemic. So it is normal for you to demand higher return for your loan, right? And the further you get in time, the higher the interest is supposed to be. So that means that for each year that passes by, the coupon should be higher. This is why the yield curve is basically visualized interest rates in a chart. It looks like this. The more time passes, the higher the yields of the bonds become, because investors obviously demand more interest for the higher risk they take. Also, as we already discussed, the longer the duration of the bond is, the higher its price sensitivity to interest rates, something known as duration risk. So if the duration risk is higher, obviously the returns have to be higher as well. So in this scenario, a money market fund which has extremely short duration because it has bonds and other instruments that mature in less than a year would have the lowest yield on the graphic. However, this is not the situation we are in and have been for the past more than a year now. What we have seen is the so-called inverted yield curve, which is like a normal yield curve, but inverted. Genius. So the yield curve that you just saw was normal, and that's how it's supposed to be. This is how it actually is now. What you are seeing is the USA yield curve. Just like in my fancy graphic previously, on the left you see the yield percentage and at the bottom the time of the bond. This is why it is inverted. Currently, you can get a 5.49% on a 1-month bond. Compare that to 4.45% on a 20-year bond. We are literally being paid right now to take less risk. This part of the yield curve is what you typically see in a money market fund. So, as you can see, it is literally the highest interest part of the curve. The situation is the same in the European Union, the United Kingdom, and other countries and regions in the world. The reason for that inversion is that central banks have raised rates very fast and very aggressively in the past 2 years, pushing the short end or the near maturity date part of the curve higher than what is known as the long end, which are the bonds that mature further in time. Alright, so now that you're a bond trading genius and a yield curve expert, let's move to the risks of the money market funds so you have a complete understanding of where you will be putting your cash. The first risk I will mention is more something to have in mind than a risk for your cash, and that is that when central banks start lowering rates, as they inevitably will, the income from the money market funds will quickly start dropping. However, as I said, this is not an investment and you are not trying to time the market. You are simply trying to hold cash and get better yield on it than your bank savings account, which is yielding you zero anyways. Another risk to money market funds is that theoretically, if a really nasty financial crisis occurs that threatens the financial system, people could panic and rush to take their money out of them, which could lead to losses for the funds and could potentially force them to close the gates for sellers for a while. However, I'm not worried at all about such a scenario because you have the absolute exact same risk with your bank. If there is a financial crisis and as a consequence, bank panic, People will start withdrawing their funds, and the banks will make up a reason to halt withdrawals, make a bank holiday, etc., etc. I actually even feel better with my money in a money market fund because I know that at least they are there, unlike with a bank that, under the fractional reserve banking principle, has only about 10% of my original money. This leads me to the next risk with money market funds, which is that they're not insured, unlike bank deposits. This is a risk, yes, but again, tying it to my previous point, I'm really not worried about it. Here is why. Answer this question for me. What makes you feel safer? Lending money to the government and high-quality corporations through a brokerage firm like Fidelity or Vanguard that has a simple business model that simply takes fees for managing assets and doesn't make loans? Or lending money to an institution like a bank which only has about 10% of their customers' deposits available and lends money to Uncle Joe to buy a home or to a mom-and-pop pizza restaurant? I think the answer is self-evident. Besides, in both situations, if there is a financial crisis that threatens the stability of the banking system or the government bond market, we all know what will happen. And that is...
We print it digitally, so we as a central bank, we have the ability to create money digitally.
So it is very clear what will happen. The central bank will print money to backstop the system, your cash will be devalued because of the new money, and everyone will get their devalued cash from either the bank or the money market fund. We've seen this before, and it will probably happen again. Another thing to point out is that even during the depths of the financial crisis in 2008, which was the biggest crisis since the Great Depression from 1930, only one fund had trouble because it had corporate debt in it that was owed to them by Lehman Brothers, which went bankrupt. The reserve primary fund broke the buck, which means that if you have had $1 in it, it went down to 97 cents. As a response, new rules were implemented, which goal was to prevent that from happening again. So there are two things for you to take away here. First, the fund was invested in corporate, not government debt, which is riskier anyways, and you should know that. And second, it only went down 3%, and that was the only case where that has happened. So the risk, even though it exists, seems pretty mild to me. In addition to that, if you think your deposits are safe, let me just tell you that, for example, in the USA, the FDIC fund that covers deposits has about $120 billion. And the insured deposits in the country are, wait for it, over 10 trillion. I won't say anything. I will just leave you with that knowledge. All right, so the last risk I want to talk about is currency risk. Always invest in a fund that has an underlying currency the same as the one you're investing in and you will be needing. Since money market fund returns are very low, you have to avoid currency fluctuations at all costs. Imagine you invest in a British pound fund that makes 3% yearly for 3 years, but your own currency is dollars. You've accumulated 9% return, but at the same time, the pound has dropped in value compared to the dollar with 10%. Well, now, when you want to take your cash and spend it in dollars, your whole return has been wiped out by the currency movement. Now, let's see some example funds, and please bear in mind, these are not recommendations, just examples. If you are in the USA or even UK, you have a lot of choices, and you probably just need to search your brokerage account, and you will find plenty of funds you can invest in. An example are the Fidelity money market funds, which you can see here on their website. They have a money market fund for all the three types already mentioned: government, prime, and municipal. If we check the government one, currently it yields 4.97%. It has returned 2.29% annually for the past 3 years and 1.10% for the past 10. In the composition tab, you can see what it holds. These are various government and government-backed debt instruments. To the right, you can see the average maturity, which means how long before the debt instruments mature on average in the fund. The shorter the maturity time, the more cash-like the fund is and less fluctuations are expected in its value. However, all money market funds in general should have maturities less than a year, and I wouldn't worry too much if one has 30 days and another one 3 months as average maturity, as they will behave roughly the same. If you're an investor from the EU, as always, things are a bit more complicated. First, because the big example funds you see will be in the USA and also carry the currency risk I just mentioned. What you need to know is that there are standard mutual funds and also ETFs, both of which are money market funds and behave similarly. I like to go with the ETF route because they generally have lower fees and are more familiar to both me and my viewers and students. For my euro, I have chosen this one, the Amundi prime Euro government bonds 0 to 1 years UCITS ETF. It has 0.05% fees, replicates the index it follows fully, meaning that it actually holds the bonds and is focused exclusively on government bonds. If we take a look at the holdings, the fund invests mainly in bonds from the biggest countries in the EU: Germany, Italy, France, and Spain. The average maturity currently is 0.4 years, which is less than 6 months. The fund is accumulating, which means that it reinvests the income from the bonds instead of paying it as dividends. At least for my country, this is better because since it is a regulated EU ETF, I won't pay taxes on the capital gains. Usually, I don't use the same logic for dividend ETFs because I like to have that income and not rely on the fluctuations of the price of the fund. However, since this is a money market fund and the fluctuations will be very little, if any, I can literally sell the gains once per quarter or yearly and create the income for myself tax-free. Because it is accumulating, it doesn't have a yield which shows the income, but based on the performance in the past year, we can see that it yields currently 3.23%. The drawdowns, or how much the price has moved, is a bit higher than I would like, standing at minus 1.65%, but this is because unlike the Fidelity Fund we just saw, it invests in bonds which have slightly longer maturity, which you should already know introduces a bit of volatility to it. However, it was literally the best ETF money market fund I could find that satisfies criteria such as full ownership of the assets, size, fees, etc. So this is why I have chosen it. Having in mind the fact that the European Central Bank has likely reached the peak of their interest rate hikes, and so when they lower rates, the bonds will go a little bit up, and the fact that it's only minus 1.65% drawdown, I'm personally willing to take the risk. For my dollars, I have chosen the Vanguard US Treasury 0 to 1 year bond UCITS ETF. Have in mind, I already have dollars which I want to put there and which I expect to use as dollars in the future. I would not do that if I had euros that I wanted to put in a money market fund, even though the dollar funds currently give higher yields because the Federal Reserve's interest rate is higher than that of the European Central Bank. Remember, a small currency fluctuation can wipe out all of your gains if you do that. So for my dollars, the best ETF I could find is this one. It tracks an index of USA government bonds maturing up to 1 year, owns all the underlying assets, has very low fees, and is accumulating. The average maturity is again below 6 months. It has returned 5.29% for the past 1 year, which is totally in line with the Federal Reserve's interest rate. The maximum amount the fund has lost, or the drawdown since the creation, is 0.34%, which is totally acceptable. Alright, these are just examples which I'm showing you and some of which I have decided to use. What you need to understand is that in some period, like the one at the time of recording this, you are literally paid to take less risk. I know it sounds scary. I know it is easier to leave your money in your bank account because that's what you've known your whole life. But the fact that you know something doesn't mean that it's safer. If the banks are doing what these money market funds are doing with your money already either way, then why not just sidestep them and take control yourself so you can make the profits that they are unjustly making with your money? Again, it's your money, your choice, and this is not investment advice. Check the disclaimer in the description, all of that stuff. But for me, after seeing how the system works, I can't find a reason to stick with my 0% yielding savings account anymore. Again, I need to stress that everything we talked about in this video is not investing. It's about keeping your cash somewhere to get higher yield. I would never do that with the majority of my portfolio, neither would I try to time the market. My strategy is still to invest in productive companies for the long term that pay me for owning them. If you want to learn more about that and want me to help you with your investing journey, then I have a free investing masterclass which you can sign up for using the link in the description. After you have signed up for it, to continue with your investing education, check the video that should have appeared on your screen right now. Thank you for watching, and I'll see you in the next one.